Welcome to part 2 of your study guide for the California Property and Casualty exam. Property insurance pays the first party, liability pays the third, and that single distinction sits underneath the entire casualty world. Today we'll work through first versus third party claims, subrogation and arbitration, loss and statutory reserves, property versus liability coverage, policy assignment, California's insurable interest law. And remember, our website has free exam guides and practice questions to help you ace your California property and casualty exam. Everything you need to prepare is right there, organized and easy to use. You'll find the link in the description below, so check it out and study smarter, not harder. So let's jump right in. Let's start with the distinction sitting underneath the entire casualty world. First party, second party, and third party. The first party is the insured, who bought the policy. The second party is the insurance company, legally bound to provide coverage. And the third party is the other person, the one you're insured accidentally harmed. Now here's the single most important takeaway, and I'd memorize it word for word. Property insurance pays the first party, the insured, for their own direct losses. Casualty or liability insurance pays the third party. It never pays your insured for their own loss. It compensates the person you're insured is legally responsible for injuring. Picture two situations side by side. In the first, your insured's house burns down and they file on their own homeowner's policy. That's a first-party property claim and the check goes to them. In the second, your insured's dog bites a neighbor who claims against the liability policy. That's third party. This brings us to subrogation, one of the most elegant ideas in insurance. Subrogation is the transfer to the insurer of the insured's legal right to recover damages from a responsible third party. In plain English, after your insurer pays your claim, it steps into your shoes and pursues whoever actually caused the loss. Let me make it concrete. Another driver runs a red light and wrecks your car. Your own collision coverage pays you quickly, which is what you want. Then your insurer pursues the at-fault driver to recover what it paid. This gets formalized when you sign a release and subrogation assignment form. So why does subrogation exist? 3 reasons. It stops the at-fault party from escaping responsibility just because their victim happened to carry insurance. It prevents the insured from double recovery, collecting twice for one loss. And it holds down claim costs for everyone, quietly keeping premiums lower. Notice the fairness running throughout. The last piece here is arbitration. When two sides disagree, maybe the insured and insurer clash over the amount of a loss, or two insurers argue about which policy is primary, they bring in a neutral third party to decide. Arbitration is usually faster and cheaper than a courtroom, so policies build it right in. On your exam, watch how these questions are framed. If the insured collects for their own damaged property, that's first party every time. If your insured harms someone else, that's third party. And here's the trap I see most. Candidates forget liability insurance pays the third party, not the insured. Here's a memory hook that sticks. Count yourself as first, your insurer as second, and the stranger you bumped into as third. First party, your stuff. Third party, their stuff. For subrogation, picture your insurer stepping into your shoes and walking over to collect from the driver who hit you. Shoes equals subrogation. What we just covered is exactly the kind of material in that free practice question bank I mentioned. These aren't throwaway questions either. They're built to test the deep understanding your California licensing exam demands, with the same first party and third party traps worded the same tricky ways. Go test your knowledge. Now let me tell you about something that can sink an entire insurance company: getting its reserves wrong. A reserve is simply money set aside today to pay obligations that come due later. It sounds like trivia, But regulators, auditors, and rating agencies obsess over reserve levels because they signal whether an insurer can keep its promises. There are two reserve types the exam cares about, and the first is the loss reserve. A loss reserve estimates the total amount an insurer expects to pay on claims reported, but not yet fully settled. Sometimes it also covers claims that have happened but haven't even been reported yet. It's a balance sheet liability. Here's how it plays out day to day as adjusters work each open claim. They estimate its ultimate cost and set that aside, updating as new facts arrive. This connects to a term you know, incurred losses. Incurred losses include both what the insurer has already paid and what it still holds in reserves. Why does accuracy matter so much? If an insurer sets its loss reserves too low, its statements overstate profit and understate what it truly owes, painting a rosier picture than reality, set them too high, and the company needlessly ties up capital it could use. Honest reserving is the whole game. The second type is the statutory reserve, and the name tells you everything. Statutory means required by statute, by state law. A statutory reserve is a mandated minimum the floor an insurer must hold to meet policyholder obligations. Statutory accounting principles, shortened to SAP, govern how insurers report these figures to California regulators. So, how do the two differ? A loss reserve reflects what the insurer realistically expects to pay, set by its own actuaries and adjusters. A statutory reserve is a legal floor set by the state, and it also falls in the unearned premium reserve. Under California Insurance Code Section 985, solvency turns on assets exceeding liabilities. Let me hand you the clean exam distinction. Loss reserves estimate what will be paid on specific claims. Statutory reserves are legally required minimums that protect policyholders. Total reserves must at least equal that statutory floor, though real reserves usually sit higher. My memory trick: loss reserve, loss estimate, statutory reserve, state statute. The first letters match. I know we're moving through a lot of detail, and you might wonder how to practice applying it. That's precisely why I built those free practice questions I keep mentioning. They let you work through scenarios that blend several concepts at once, exactly how the real exam combines them. The link is in the description. Let's tackle the big one now: property coverage versus liability coverage. Start with a picture. A fire guts your insured's warehouse. On another day, a customer slips on your insured's wet floor and breaks a wrist. Those losses feel similar because both cost money, but insurance treats them as complete opposites. Property insurance protects the insured against loss to their own property. It's first-party coverage, straightforward and inward-looking. A covered peril, fire, theft, or wind damages something the insured owns, and payment flows back to the insured. That warehouse fire is pure property insurance. The insured's own pocket gets made whole. Liability insurance points the other direction entirely. It protects the insured against the financial fallout of being held legally responsible to someone else. The trigger isn't damage to the insured's property. It's the insured's negligent act harming another. That slip and fall is liability. What the insured owns is a legal obligation to the customer. California puts this in writing. Insurance Code Section 108 defines liability insurance as coverage against loss resulting from liability for injury suffered by a person or for damage to the property of others. The words that matter are of others. Casualty coverage is about your insured's legal liability to other people. Underneath every liability claim sits a legal concept called a tort. A tort is a civil wrong, as opposed to a crime that harms another and creates legal liability. Liability insurance covers unintentional torts, the ones involving negligence rather than deliberate misconduct. That word negligence is doing enormous work, so let's slow down and unpack it. Negligence is the failure to exercise the care a reasonable person would use in similar circumstances. Here's what you truly need. To prove negligence, 4 elements must all be present. A legal duty must be owed. That duty must be breached. The breach must be the proximate cause, and actual damages must result. I want to nail down one rule candidates constantly get backwards. Liability insurance never pays the insured for the insured's own injuries or property damage. Suppose your insured causes a crash through their own carelessness and breaks their own arm. Liability coverage does nothing for that arm. It only pays the third party your insured harmed. On the exam, the fastest way to sort any coverage question is to ask whose loss is being paid. If it's the insured's own property, that's property coverage. If it's harm the insured caused to someone else, that's liability. And when a question lists the negligence elements, leaving out damages or duty is a classic trap. To remember the 4 negligence elements, I teach the phrase duty, breach, cause, harm. 4 words telling a little story. Someone owed a duty, they breached it. That breach caused something and real harm followed. Say it out loud a few times and it becomes reflex. Miss any link and negligence is not proven. If these more advanced ideas feel challenging right now, please don't worry, because that reaction is completely normal, and it's exactly why I created that comprehensive practice question bank. Working through real problems is how abstract rules turn into instincts you can trust under pressure. Head to the description and try a few before we continue. Let's shift to policy assignment, and I want to start with why the rule exists. Assignment means transferring your rights or benefits under a policy to someone else. Here's the key insight. An insurance policy is a personal contract. The insurer priced it around one specific insured's risk, so it cannot simply be handed to a stranger. That personal nature drives the core California rule. A policy may not be transferred to anyone else without the written consent of the insurer, and this applies to both property and casualty policies. Notice the word written. A verbal nod is not enough. The insurer must agree in writing before an assignment carries legal weight. Why does the insurer get this veto? Imagine assignments were free. A careful, low-risk driver could buy a cheap policy, then quietly assign it to a reckless relative with a terrible record. The insurer would suddenly cover a risk it never priced. The consent requirement lets the company re-underwrite before taking on someone new. Here's how it works in practice. Say your insured is selling their business and wants the buyer to inherit the existing policy. The insured must request the insurer's written consent. From there, the company can agree, decline, or agree, but adjust the coverage or premium. If consent never comes, any attempted assignment is void. But there's one crucial exception the exam loves. If the named insured dies, the rights and duties under the policy transfer automatically to the insured's legal representative, the executor or administrator of the estate, and no consent is required. That representative stays insured until the renewal date, so coverage doesn't vanish while an estate settles. So how might the exam test this? Watch for a question about someone selling a business or handing their policy to a friend. The answer hinges on written consent. Then watch for the death scenario, where the trick is that consent is not required because rights pass automatically to the legal representative. 2 opposite answers. My memory hook for assignment is short. Living transfer needs a signature. Death transfer does not. While the insured is alive and voluntarily moving the policy, the insurer must sign off in writing. When the insured dies, the estate steps in automatically. Living equals written consent. Death equals automatic. That contrast covers nearly every question. Remember that mastering this material takes repetition, not just a single watch. Those free practice questions were designed specifically to help you take what you're learning here and turn it into genuine exam-ready skill. Every question mirrors the style and difficulty of the real California exam, so nothing on test day feels unfamiliar. Now we reach what I consider the crown jewel of this material, insurable interest under California law. Here's the big idea. Without insurable interest, a policy is really just a bet. The insured wagers a loss will happen. The insurer wagers it won't. The law forbids that because insuring things you have no stake in invites losses. California nails this down in Insurance Code sections 280 through 287, and the exam pulls questions straight from them. Section 280 is the foundation, and it's blunt. If the insured has no insurable interest, the contract is void. No stake in the outcome means no valid policy. Everything else builds from that. Section 281 tells you what qualifies. Any interest in property of such a nature that a peril might directly harm the insured counts as an insurable interest. So ownership qualifies, but so does a mortgage, a lease, or a security interest. The test is simple. Would you take a real financial hit if this property were destroyed? Section 282 lists 3 permissible forms of insurable interest in property. First, an existing interest like plain ownership. Second, an incurred interest, an incomplete one that grows out of an existing interest. And third, an expectancy, but only when coupled with an existing interest in the thing the expectancy arises from. That third form has a catch. Now the single most tested rule in this entire section, 283. A mere contingent or expectant interest not founded on an actual right to the thing, nor on any valid contract for it, is not insurable. This is the exclusion. Pure hope, with no present right and no binding contract, gives you no insurable interest. Let me show you the classic trap. A man expects to inherit his mother's house someday, but she's alive and hasn't signed anything binding it over. Does he have an insurable interest in that house right now? No, he has no present right and no valid contract, only a hope. That's a textbook 283 answer. Section 284 sets the measure, the size of an insurable interest. The measure equals the extent to which the insured would actually be harmed by the loss. So an owner of a $500,000 building has an interest up to that amount, while a bank holding a $100,000 mortgage is limited to that. Section 285 carves out a special case for bailies. A bailee is someone holding another person's property in their care. Think a dry cleaner, a warehouse operator, or a repair shop. Even though they don't own the goods, they have an insurable interest up to full value, so a dry cleaner can insure customers' clothing. Section 286 is all about timing, and property and life insurance follow different clocks. For property insurance, the insurable interest must exist both when the policy takes effect and when the loss occurs, though not in between. For life insurance, it only has to exist when the policy begins. That difference appears often. Picture this. Someone insures a house, then sells it, but leaves the old policy in force. Months later, the house burns and they try to collect. Can they? Absolutely not. They had no insurable interest at the moment of loss because they no longer owned the home. The policy on paper changes nothing. The final rule, Section 287, seals the door. Any stipulation in a policy promising payment, whether or not the insured has an interest, or treating the policy itself as proof of interest, is void. In other words, you cannot contract around the insurable interest requirement. This reinforces Section 280 and stops wagering. Here's where I'd spend your study time. Section 283 is the heavy hitter. Whenever a question describes someone who hopes to inherit or expects to receive property in the future, with no current right and no signed contract, the answer is no insurable interest exists. Also memorize the property timing rule, inception and loss. To keep the section straight, try this ladder. 280 says no interest, no contract. 283 says no hope alone. 284 says size equals your loss. 285 says Baileys are covered. 286 says property needs interest at start and at loss. Recite those 5 and you own the hardest topic. As we head into the home stretch, remember that understanding these rules is only step 1. Real mastery comes from applying them again and again, which is exactly where those free practice questions become invaluable. They're completely free, built for California property and casualty success, and they show you instantly which sections need more work. Let's speed through high-value comparisons the exam adores, starting with how policies get cancelled. Pro rata cancellation is when the insurer cancels. The insured gets back the full, exact, unearned premium with no penalty. Short rate is when the insured cancels early. They get back less because the insurer keeps a penalty. Flat cancellation returns everything. Now don't confuse cancellation with two lookalikes. Cancellation happens before a policy expires, by an active decision from either side. Non-renewal happens at expiration, when the insurer chooses not to continue coverage into a new term. And a lapse also happens at expiration, but because the insured failed to pay the renewal premium. Different reasons. One more trio. The 3 ways insurers set rates. Judgment rating leans on the underwriter's expertise, with no tables used for unusual one-of-a-kind risks. Manual or class rating uses published rate tables for most standard policies. Merit or experience rating adjusts the manual rate using the insured's own loss history, common in workers' compensation. Underlying all the cancellation math are 2 premium terms. Earned premium is the portion the insurer has already earned by providing coverage for the time elapsed. Unearned premium covers the policy period that hasn't happened yet, and it's what must be returned when a policy cancels. Elapsed time is earned. Future time is unearned. For these comparison questions, the exam almost always keys on who acts and what it triggers. Insurer cancels, think pro rata and no penalty. Insured cancels, think short rate and a penalty. Insurer walks away at expiration, that's non-renewal. Insured forgets to pay, that's lapse. Match the actor to the outcome for easy points. A quick trick ties the cancellation types together. Short rate has the word short in it, and the insured comes up short on their refund for cancelling early. Pro rata is proportional and fair, the insurer being fair when it cancels. Flat is flat out, everything back. Short for loss, pro for proportional, flat for full. Let's bring it all together. We separated first party from third party, and you learned property insurance pays the insured, while liability insurance pays the person you're insured harmed. From there, subrogation lets the insurer step into your shoes to recover from the at-fault party, and arbitration settles disputes without a courtroom. We covered loss reserves versus statutory reserves, the property versus liability divide with its 4 elements of negligence, and the assignment rule turning on written consent, except when the insured dies. And we climbed the insurable interest ladder from 280 through 287. Notice how it connects. Every rule protects fairness, solvency, or contract integrity. Now, if some of this still feels shaky, that's completely okay. Nobody masters insurable interest or the negligence elements on a single pass. What separates candidates who pass from those who don't isn't raw talent. It's repetition and honest practice. You've just built a genuine framework for the hardest part of the casualty domain. So here's your next step. Don't forget to grab those free practice questions from the link in the description. With the knowledge you've gained today, plus real practice on exam-style problems, you'll walk in genuinely prepared and confident. Keep at it. Trust your preparation and go earn that California property and casualty license. That wraps up part 2 of our Casualty Basics review. Craving more practice? Head over to our website where you'll find hundreds of free questions and complete study guides ready to explore anytime you like. It's all there waiting for you, completely free, no cost, and absolutely no catch involved. Just click the link in the description below to dive right in and start learning today. Subscribe and stay tuned for the next part. Good luck on your exam.